Making a business acquisition offer. So a lot of people want to buy companies, a lot of people want to sell companies, and they say, okay, when offers come in, either from the buyer side, what should they look like, or from the seller side, what should we expect? And really, they can change, and there's a lot of nuance, and everybody has a slightly differentiated approach to this. However, there are 4 primary elements that you will see in every legitimate business offer that if you're buying a company, you need to incorporate, and if you're selling a company, you need to look for. So the first of these is value. What we mean by value is the purchase price. We are valuing the company at X dollars. Now, sometimes that will come with support, and that can be helpful. If we're thinking of it in terms of this much multiple of EBITDA or pre-tax profit, this way looking at gross profit, this way looking at revenue, that can all be good, and any indication of support or why that value is there can be helpful, but in any event, needs to be a value. And this sounds pretty self-evident, but we've received many values that have a range. And that can be okay at the indication of interest level, where someone says, look, based on the information that I get back, I'm thinking it's going to be between this amount and this amount, depending on the information, and here's what I'm looking for in the information. And if you can define that very clearly, that's understandable. But if someone says, well, it's worth $1 to $1 billion, depending on this or that, that tells us nothing. And that's going to quickly invalidate or delegitimize any offer that comes in. The second component is structure. So typically in a deal, not 100% of it is always at closing. Now there are some situations where it's a cash at close situation. There are some situations where a portion of it is paid over time, and oftentimes the seller will do what's called hold a seller note. You'll hear the phrase hold paper as a reference to old real estate deals, but it happens in the business world quite often where someone will say, we'll pay 80% for the business at closing, the rest of the 20% we are going to pay over 5 years at a 8.5% interest rate, effectively comparable to debt, but the holder of the debt, or the creditor, if you will, being the seller of the company. Another instance is rolling equity forward. So you'll see we're going to buy 70% of the business and 30% of the equity we would ask to roll forward into the next ownership group of the business, a smaller piece of a much larger pie of a Oftentimes you see this in private equity consolidation strategies where they're buying up lots of businesses to aggregate them. And what they'll do is do this for 5 to 7 years and then sell the total compiled business at a much higher price and multiple. And you can see some of our videos on multiples expansion, how private equity works, to get more information on that. And in doing so, they are typically asking all of these selling parties to roll over some equity or roll forward some equity. And again, that could be as little as 5%, it can be as much as 40%, typically not a majority. But in any event, the concept here is the structure. What is at close? What's over time? And the stuff that is over time, is it equity rolling forward? Is it a seller note? Is it something different? But those are kind of the typical big moving parts there. So you have value and then you have structure. How much? What's at closing? What's over time? What does the overtime look like? Next is the transition period. And again, this can be very different in any particular situation or transaction, but oftentimes if somebody sells a business, they are ultimately, the owners, going to phase out of the business. Now, if they have all of the management in place and the owner is purely a passive owner of the business, which is rarely the case, the middle market and lower middle market, well, then that person can leave day one. If they still have their hands involved in different things, then we really work with the sellers to have standard operating procedures, job descriptions, and other things in place to make sure that that process can be facilitated expeditiously. But depending on the situation, depending on the different people's objectives, it can take different shapes. Sometimes sellers say, I just want to get out of the administrative and operational components of the business, but I'm happy to stay around as a salesperson, as a manager going forward for this next iteration, for this much time, for this many years. And there's other situations where they would prefer to leave early, but the buyer is saying, we need this person in place to make sure that the brain trust of the business transfers smoothly to allow us to continue to be successful. And so there's a bit of a tug of war. It is often a negotiated point, but it is a component of the deal. And so if you are a buyer of a company, think about ownership, think about management, and think about what you would need to be successful. From a seller's perspective, think about the buyer, what they would need and what they may perceive to be necessary to be successful, and how can you preemptively attack some of those things such that you can minimize the transition time if desirable, and if it's desirable to be involved longer, to define clearly the things you'd like to do and the things you wouldn't like to do. Lastly is the stakeholders. So what we mean by that are largely the employees, any community involvement beyond that. And so when buying a company, you always want to perceive what is the value being placed on all of the employees by ownership. And depending on how that is viewed, there may be some deference paid to your offer if you are treating the people that are important the right way, which it should be, but it's something to keep an eye out for, because I think sometimes people get too caught up in purely the numbers and they say, well, what are really the objectives of ownership? And in most situations, you're going to have ownership that is desirable, taking care of its people. So if you can show that in your offer, then it will be better received. And as a seller, if it is important to you, which it is in most situations, of how the employees are handled, how the employees are taken care of after you exit the stage, then it should be something that you want specified on the front end of a deal. And so again, another important part that if you're putting forth an offer, you want to include, and if you're selling a company, you want to see. And so there are, again, other elements that find their ways into letters of intent, into formal offers for businesses, but these are the four main categories that if you're buying a company, you want to include, and if you're selling a company, you want to look for. Value, the price being paid for something. Structure, what's at closing and what's over time. Transition periods, what does ownership's responsibilities look like on a post-transaction basis. And stakeholders, how are the employees and community considerations taken care of on a post-transaction basis as well. So that's the thought for today. Hope the week continues to go well. Keep pushing forward. God bless. We'll see everyone next time.